in this video, extensively we are going to cover these terms that are associated with forex trading and the meaning so far. So in the video today, I'm going to be covering terms like the ask and the bid price. We're going to be looking at what the word spread means. We're going to look at bearish market, bullish market, opening a position, closing a position, going long, going short. We're going to see the meaning of PEEP. We're going to see what margin is all about, leverage. So these are the things that we are going to cover in today's class, extensively, so that it will help you to understand or to have a basic knowledge of what forex trading is all about. Let's start with the ask and the bid price. The ask price. What is the ask price all about? It's the price at which the market is willing to sell at. It's called the ask price. The ask price on a chart is always represented in red. That is the price at which the market is willing to sell to you as a trader. Then we look at the bid price. This is the price at which you, the buyer, you are willing to buy at. Now I want you to understand that the bid price on a chart, it could be either blue or black line. Now I want you to note very importantly that the bid price is always lower than the ask price. Reason is that the market will want to sell it at a high rate to make its profit. So you as a trader, you will be waiting for when the market will come down to enter the market, and as the market rises, you make your profit. Now number two, the spread. The spread is the difference between the ask price and the bid price. It is also a token charged by your broker for engaging your trade. A broker is someone that gives you access to the platform of trading. Now, where he gets his own commission is from your spread. Now, the spread is measured in pips. Number three, we look at the bullish and the bearish market. So we're going to start with the bullish market. A bullish market occurs when the market price closes higher than it opened. A bullish market also occurs in a trading day where the bulls dominated the market. Now the bulls are used to represent the rising power of the market. A bearish market. A bearish market occurs when the market price closes lower than it opened. A bearish market also occurs in a trading day where the bears dominated the market. The bears, just like I explained to the bulls, the bears, these are the downward power that controls the downward movement in the market. Now let's look at the opening and the closing position. Opening a trade simply means to initiate a trade. You can decide to go long or you can decide to go short. Now closing a trading position, it means to exit from the trading initiated, going long and going short. Now we're going to explain these two. Now let's look at going long. What does it mean? Going long simply means initiating a trade on a buy order. Now let's look at going short. What does it mean? Going short simply means initiating a trade on a sell order. Now let's look at another term, PEEP. The word PEEP is an acronym which means price interest point. It is the difference between the buying and the selling price of a currency pair, because we are dealing with forex here. Now looking at the example that is on the screen, you discover that if I subtract 0.10225 from 0.10240, you will discover that the difference will be 15 PEEP. If you want to understand properly, there is one of my video I treated how to calculate PEEP. I would advise you to go there to be able to get it accurately on how to calculate your PEEP when you are going long and how to calculate your PEEP when you are also going short. Let's look at the word margin. What does margin mean? Now this is the amount specified by a broker to enable a trader open or operate a trading account. In a nutshell, it is the initial trading capital invested to open a trading account. Leverage. It is the amount of value added to the margin of a trader by the broker in order to enable him control larger value of contract or stock. Leverage are often measured in ratio. You have 1 to 50, you have 1 to 10, you have 1 to 100, 1 to 500, 1 to 1000, depending on your broker. Now let's look at it. For example, if your margin, if the initial money you deposited in your trading to get a trading account is $100 at the leverage of 1:500, it means that your broker is giving you 50,000 worth of value to enable you control large contract or stock in the trading market. With this, we have come to the end of the class today.